Hello, hello, everyone. Welcome. Come on in. We have a lot of attendees today, so we're excited to get the ball rolling. All right. I hope everyone's having a great evening. It's a rainy evening here in Maryland, so if you are local, hopefully you are safe and sound indoors. All right. So we are going to go ahead and get started. I want to introduce the amazing panelists that we have. I'm going to start with myself. My name is Jarnika Trent. I am the Membership Development Specialist for the United States Senate Federal Credit Union, and today I'm going to be your host this evening. With me, I have the amazing marketing team. Also, my colleague, Milton. But I'll start with marketing. So we'll start with Carrie, who put this amazing presentation together. Thank you so much for all that you do. I have on the line also Eddie. You can come off mute and say hi to everyone, Eddie.
Welcome everybody to another weekly Wednesday webinar. I appreciate you, Jarnika, for that warm intro. And as you can see, she's a natural. So thank you very much for that amazing intro. And we're excited to see all the attendees. And I did see a familiar name. We did a project earlier today. So Madison, we saw you in person and now we're seeing you online. Wow, you committed. Thank you very much for your support. So
Yes, thank you, Madison, for joining us. Awesome. All right, we're going to keep the ball going. We have amazing Eli. He is the amazing coordinator over there in marketing, in my right hand. So hi there, Eli. Andrea over there also in marketing. She's going to be there with Eli helping you guys with any questions or answers. And we have Milton, who is my fearless leader, who's also on the call this evening with us. And last but not least, we have our amazing presenter today, Mr. Michael Schimmel, who's going to talk to you guys about retirement solutions and smarter ways to retire. So with that being said, we're going to go ahead and get started. And if you have any questions, feel free to drop them in the chat. And we'll be happy to answer any of those questions as we go along. So thank you all for joining, and we look forward to hearing from you guys.
Thanks, Jarnika. Hey, everybody. Again, Michael Schimmel from Fellows Financial Group. We have been partnered with the United States Senate Federal Credit Union for coming up on 6 years. So always a pleasure to be able to join you here tonight and share with you some good content. Tonight, we're going to talk about, different things to be considering to retire smarter. But before I kind of get started, I want to kind of give you a little synopsis on why I'm here. Why do I do this? Why do we have this partnership? We at Fellows, right, working with individuals, this is one of the most personal things that you do. I saw firsthand my grandparents go through a period of time. My grandparents, first generation to the United States, grew up, worked hard, suburbs of Chicago. My grandfather was a carpenter maker, had a union job his entire life. My grandmother was a typist. They raised a family of five in a three-bedroom house, a family of six in a three-bedroom house, and in the suburbs of Chicago. And, they love to dote on their kids and then their grandkids. I'm one of 19. And so when I'm working with clients, it's pretty personal because I saw my grandparents have all the abilities from a financial perspective because they had saved, had money in the market, had good counsel relatively around them. And then, the market fell. And I saw a dramatic change in their, just perspective. They always loved to go on trips, cruises, furs back then, all the wonderful things. And that lifestyle came to a screeching halt for them. There was a significant market pullback and they didn't have a plan. And so they failed to have that plan. And without that plan, they let fear set in and really just took everything out of the market, which might have been the right decision for a short period, but they never put it back in. They didn't have the guidance. They didn't have a plan. And so that still affects them today. My grandfather he passed away about a year and a half ago, but my grandmother's 97, still working, or excuse me, still living in the house that they retired in. and she has a mortgage, and she, money's tight. And so it wouldn't have been tight if they had made some of the right decisions early on. And so you'll hear it again, but you only retire once. And our job here at the credit union and through fellows and our partnership is to help answer those questions. Today is not about products; it's about talking about planning and situations. So, with that, just we're looking forward to some interaction as much as we can through Zoom, and we're going to jump right in. There's the slide switches. So this is what I normally call the three-legged stool of retirement income planning, or really more effectively, what the three-legged stool was, right? So this first leg, right, everybody sees that we've got a pension, and this is how many of our parents retired. There's a decent number of us in the DMV area that work for the government that have pensions as well. But our parents definitely had this pension ability out there. And, normally the workforce, you would work for the same company for 30, 40 years and have this pension benefit, and then you would have Social Security, right? And so what is a pension? The pension is just really a payment from your employer for the rest of the life as a portion of your salary or what you worked on a regular basis. The other kind of leg of this stool is Social Security, right? So we all have Social Security as long as you work 40 quarters, so work 10 years in the workforce, you're eligible for Social Security. But that was created as a benefit, right? To supplement, not to be the main source of retirement, right? So it's one portion of your retirement kind of stool, And then you also have, you've got your personal savings, right? What is that? Well, for my grandparents that I alluded to in the beginning, that was just like taxable accounts. IRAs weren't big, 401ks weren't big back then. Nowadays, we've got TSPs if you're in the government, which is like a 401k. You've got 401ks, SEP IRAs. You've got taxable investing. Robinhood has really, opened the doors, and a lot of other institutions have made it, really cut down on the barrier of entry to enable people to invest and accumulate more personal savings in an easier way than they have. Unfortunately, we've gone to a different type of economy, and most people don't work in the same company for 30 to 40 years, and most of them don't have pensions. So we really kind of get rid of that leg. And well, what does that do? Well, we've got a two-legged stool that's unstable at best. And one of those legs is maybe cracking a little bit. And we've got Social Security. Well, Social Security is not going to go anywhere, but you do have an opportunity where it might get reduced. So if we look at kind of this next slide, Social Security Administration, this is their own data, should last until 2033. Now, that doesn't mean that you're not going to get Social Security after 2033, but it does mean you could take a reduction in benefits. Up to 21% is the projection as of right now. These dates change a little bit over time, but the story is really that you have to take into consideration the potential, hopefully it doesn't happen, of a 21% reduction in your Social Security. So if you're waiting to full retirement age, 66, 67, or 70, so you maximize the benefit, that extra 3 years that you waited till 70 gives you 24%. But if Social Security doesn't get fixed in a political compromise, well, that 24%, 21 of it's gone. So, unfortunately, that Social Security is something that we have to plan for. And if you don't have a plan, then what do you call that? Well, we're planning to fail. So if we have Social Security a little so sketchy, and then we've got maybe we don't have a pension, a lot more pressure is on our personal savings. And our personal savings is taxable money that we've saved maybe in a bank account, in CDs. It could be in retirement accounts, right? Are they traditional IRAs, 401ks, TSPs, 403bs? Are they Roth IRAs, right? Have you paid your taxes today and never pay them again? that personal savings is going to have more and more of an impact and going to be more important into that retirement income stool of where you're going to get money. Because when you stop working, what happens? You stop getting that paycheck, right? So you're used to getting that paycheck every 2 weeks or twice a month. Well, that paycheck needs to come from somewhere. Well, Social Security, even if it's not reduced, isn't replacing 100% of it. Your personal savings needs to kick in. Maybe you've got a pension, you're lucky enough, and you work for the federal government. That's still not going to replace 100% of your income. So if you have a pension and Social Security, maybe you're coming close, but you still need to supplement it in your personal savings. But the point is, most of us actually have more and more pressure on our personal savings and the ability to maximize our Social Security in our lives. And we need to be able to plan appropriately to figure out, well, how do I make sure that I do have enough income to meet my goals? It's really important. And if we're not having a plan, then, well, we're just kind of leaving things up to the wind, right? So, we've got an opportunity, and, I see it quite often, right? So I had a couple come in, we'll call them Roger and Debbie, and they came to, one of our presentations that we're doing just like this. And at the end of the evening, they wanted to sit down. And a few days later, we came in and, Roger was like, hey, he's like, Mike, one of my biggest concerns is we're behind, right? We didn't get the best jump on things. We've got things here and there. I'm worried about running out of money when we retire. And so I asked him to explain, and he told me a little bit more about the situation. And over the course of 30 years, Roger had 3 different jobs. He had worked in the printing industry, owned a small business for a little bit. He was about to retire. And after 19 years with the company, 3 years, he had 3 separate retirement accounts. And together, him and Debbie had some savings, some bonds, a few stocks, etc. But the more we got talking about it, it just kind of sounded like they had a junk drawer, right? And so, I don't know about you, but I've got a junk drawer. But we don't want the junk drawer for our finances, right? In talking with them, it really, it's like, wow, we had this over here, that over there. They weren't getting statements for certain things because they had used a work email, and they had forgotten about, something that they just got a notice on that it was going to get forfeited to the state because nobody had claimed it. Folks, we see this all the time. And unfortunately, when you've got things in a junk drawer, when you go searching for it, you'll find a bunch of things, but sometimes you don't find what you need, right? It's rarely that you find that screw that you had saved for that toy or that right cell phone charger cord, because there's 500 different, inputs that you could use. So what we want to do and what we don't want with people is to have a junk drawer full of finances. I had a client show up with a suitcase full of documents because she didn't know which ones were important, which ones she should throw away, and which ones actually meant something. And we went through a full carry-on full of documents and simplified it. And we got it down to the information that was necessary. And then we took that information and we put it into a plan, right? So you want a financial plan. A financial plan is a written income plan that lays out exactly how the sources of income are going to be tapped into, in what order, in what amounts over what periods of time, to keep with your retirement lifestyle from ever being disrupted. Now, folks, if you haven't had, something like this, like a written retirement income plan, you're not alone. A lot of people actually don't. Studies show that about 80 to 85% of individuals do not have this type of planning done. Now, some people will be like, well, I've got something, right? And they will go in and, talk with their advisor, or if they don't have an advisor, guess what they'll do? They'll look at their statements. Hey, all right, it went up, things are on track, and then put it away or close out on the file. But unfortunately, we've got to do a little more digging, and you really need to understand, because when you access certain buckets of money, how you access them. Are they taxable? Are they taxed, today? Are they tax deferred? Are they never going to be taxed? Is it better to take tax deferred money in the beginning of retirement or tax exempt money in the beginning of retirement? Having this written out in a plan is really important. And if you don't have a plan, you can access that, engage a financial advisor, right? I'm a financial advisor. We're partnered with the credit union. Engage one of us at Fellows. Or if you have an advisor, engage them and press them for an actual income plan. If they can't give it, I would recommend you find somebody else, because the value is not just managing the investments. The value is about having the confidence and the security that you're going to be able to not have to worry about money in the lifestyle that you want to have. So some people, will come back to me and say, well, look, I don't need a plan. I am good. I've saved up enough money. I've used some financial calculators. I'm going to talk and utilize this, the 4% rule. Well, I'm sure a lot of you guys have heard the 4% rule. Some of you have actually probably heard it called the 5% rule, because that's what it used to be called. So the 4% rule is basically, if you take your money and you take 4% and no more, you should never run out of money. Unfortunately, when you actually do the math and look at the results, it's closer to 3.8. And that 3.8 is not a great spot because, well, we've got, longevity that keeps pushing that number down, inflation that keeps pushing that number down. And so, 4% isn't too exciting, right? So let's take $1 million and, we'll give you two examples. Maybe we've got 3% spending. Maybe we actually have the 4% rule in stock. Well, if you've accumulated $1 million in your retirement accounts to, keep your lifestyle going, and you want to, just take out 2, 3, 4%, 5%, well, that's giving you 30, 40,000, maybe $50,000 a year in income. Now you're going to be eating into principal at some point. And honestly, if you accumulated $1 million in retirement assets or taxable assets, or tax deferred assets, it's still not very exciting, right? Because you're used to living at a higher lifestyle. In the Virginia, DMV area, Social Security normally will equate to about 25% of somebody's income. So the rest is made up of personal savings or a pension if you're lucky enough. And most of that, about 30% of the people in this area have a pension because of the federal government. The other 70 do not. And so you've got a significant portion where you need that money to create income. And how do you do that, right? What is the right amount of risk? How do you understand when you should be taking from different buckets? Should you be taking more or less if the market's up or down? What about RMDs, if I need them or don't need them? It all becomes a question of risk, right? And so everybody's got to have that conversation about what is the right risk. What risks do I actually need to be looking at, right? This is a conversation you have with your spouse, your family, your advisor, right? There's all sorts of different risks. Which one is most important, right? So we've got, market risk. Everybody kind of understands that. Market's going to go up, market's going to go down. We just experienced a significant kind of gyration in the market. COVID, huge. Just right here, in April, right? We had the tariffs scare, so to speak. In short order, we're back in both cases, back to where we were. So these have been short-lived. But in most cases, it's not short-lived. Interest rate risk, right? We used to have rock bottom interest rates. Mortgages were at 2.5, 2.25, 3%. Now where they are, they're at 7%, 7.5%. Car loans, same thing. Used to be 0% financing everywhere. Well, now new car loans to 2.9, 3.9. Used car loans, 7, 8%. What about taxes? Right? I'm not going to get into the big, beautiful bill, that was just passed. But taxes, that's a real risk. Every dollar that you make is taxed, right? You want to pay more or less? How is that going to impact the longevity of your money? You know, we could keep going on. Inflation, right? We're hearing a lot about inflation, political risk, depending on where you are. So there's all types of different risks, relationship risks, um, you know, it, my wife sometimes, talks about that risk, but that's not really the risk we're talking about. It's really, hey, what happens maybe if your spouse or partner doesn't come home one night? How are you going to deal with that from a financial perspective? That's the relationship risk, the family risk, right? Longevity. Every time when Social Security was created, the average age of somebody living was 80, 79, 80. Now, the average age for most retirees who are entering retirement is 93 to 96. My kids, who are, my youngest is 9, they're expected to live over 100. So, which risk is the most important? I don't know, right? And then neither does, it's really hard if you're not talking through this through a profession with a professional, or talking through, where your risks are, because everybody's got different risks at different stages of their lives. But when you've got a plan that helps understand the risk and look at timing, right? Market timing, longevity. What happens if the market, doesn't perform at a certain level? What am I going to be looking at? What happens if it overperforms? What am I going to be looking at? Looking at different scenarios is really important to understand the different types of risks that are out there, right? And so one of the things that we look at is, market risk, right? So we had a great time, leading up to 2008. That's what that green arrow is. And the green arrow shoots, really the beginning of 2008. And in 2008, most people were probably thinking, man, my portfolio is at an all-time high. I think I'm going to retire. It's a great time to retire. I'm about that retirement age, got the most money I've ever had. I'm going to retire. And then they pulled the trigger. Unfortunately, what happened shortly into 2008? We had a huge pullback, and pullbacks are a part of life. But if you've retired and we have a pullback, we got an issue. So if people retired in 2008 because they thought they had an all-time high in their portfolio, well, it took almost to the end of 2009 to bottom. Then it took till 2012 to regain the 2008 highs. So you lost 4 years. And if you retired during those 4 years, 2 of them were on a downtrend, and you were taking money, most likely from your retirement accounts. So now your principal that you retired with is much lower because you were taking money as the market was falling. So we consider that's a market risk. We call that sequence of return risk. And that's really a very important thing that you need to be considering when looking at the retirement picture and having a secure retirement plan in the future. And so we'll look at 2 fictitious, brothers. We've got Steve and Bill, and, they're looking at retiring. They both left work in a consulting business, and both of them, really did, the same type of work, but they retired a little bit different, right? They're retiring in 2010. Bill's retiring in 2000. And, this is a fictitious example, but what I want to show is the difference in when you retire makes a dramatic impact in the potential income and the potential investment account balance that you have. So if we look at Steve, well, let's look at Bill first. If we look at Bill retires in 2000. In the first few years, maybe this was the 2008 example you could put in here, but you got some negative numbers in regards to the overall market, minus 10, minus 13, minus 23. But then we've got some positive. And every year, Bill needed to take $30,000 out of his account. At the end of the 10 years, 2000 to 2009, at the end of those years, he had $96,000 left in his IRA. But he was able to take 30,000 out per year. And he's got, it was a 23% return over those periods of time. Steve, on the other hand, retired 10 years later, different type of market. And in the first few years, the market was up. Yeah, the first year it was up. The next year it was zero. Next 2 years, we had some good years, and then we got some negative years. He took the same $30,000 out. They took out the exact same amount. But because he took out money in up years, which is, different years, different scenarios, he's ending with $874,000 in his IRA after 9 years versus 96 as Bill. So most people don't have the luxury of changing their retirement date by 10 years, but you do have the luxury of probably changing it maybe by a year, 6 months, something of that nature. And then there are things that you can do specifically to address this risk. We call this, when you're kind of going into retirement, about 10 years before retirement, 10 years after retirement, the danger zone, right? And so, the retirement danger zone, you no longer want to be investing like you used to in your 20s, 30s, 40s, early 50s, right? If you're retiring at 65, at 55, that retiring kind of matrix should change. And it should get a little more conservative. It should get less correlated to what the overall market's doing. Because when you're in your 20s, 30s, 40s, 50s, early 50s, you've got time to recover. When you're in if you're in the same type of portfolios as you enter 60 and you're going to retire at 65, and we hit a 2008, right? Right now, we're at all-time highs. Is it a great time to retire? I don't know. Can your portfolio, can your retirement plan take a 30% loss or a 40% loss and draw on it, right? You've got to have a plan that dictates that and runs these different scenarios. The other thing is longevity, as we talked about. Longevity, most people will live, they start retirement in their 60s, maybe late 50s, but 60s for sure. You have 30 years in retirement that you need your assets to last. That's a significant portion of the life that you have only done. So you've got to take advantage of looking at this period of time in a different context, because you only have one opportunity to retire once. So when you're accumulating money, right, it's kind of easy, right? And I say that tongue in cheek, but you put your money in, maybe you get some indexes, maybe you pick some stocks, have a diversified portfolio, or you're saving in the right accounts in the right way over time. Slow and steady wins the race. Perfect, gets you to retirement. But now it's all about decumulation at that point, or preservation when you get into retirement. So the 10 years before and the 10 years after retirement are really critical, and you only get to do it once. And so it's really important when you look at your situation, if you don't have a full-blown financial plan that kind of details how are you going to deal with your assets, what are you going to do from pre-tax assets to after-tax assets to taxable assets. Hey, I have a pension. When do I pension maximization? Hey, I've got, maybe an inheritance coming. How does that play into my situation? You got to have all of these things taken into account. It's really important. And that will help minimize the danger that you have as you approach retirement and kind of those first few years in retirement. The next thing is taxes. So we all know what April 15th is, right? It's the day the government gets their due. It's the day we also write a check, most of us. And if you're not writing a check, you remember, you've been paying taxes all year in your income. So, it's just a true update, for some of us, if we have to write a check. And some of us, well, great, we get a refund, which is good. But unfortunately, taxes still play a really important role in retirement. And the reason is most of us have saved for 20, 30, 40 years in pre-tax money inside our 401ks, inside our TSPs, inside our 403bs, IRAs. Only recently, in the scheme of things, we've had Roth options, which is after-tax contributions. Pay your taxes today, never pay taxes on that stuff again. But it's only in Roth accounts. Your taxable accounts, you're paying taxes every year on the growth if you're making, buying and selling. Pre-tax accounts, they've never been taxed. You're going to, as the distributions come out and the government requires them at RMDs, which is 73 for some and gets a little later for depending on your age, you've got those required minimum distributions, which will then count as income. And so I've got a short little quick example that I want to go through. And it's how does saving $155,000 on tax, so you've saved $155,000 of income, like you didn't pay taxes on it, perfect, right? Probably saved you, I don't know, 30% of 155,000, so 45,000, give or take. But that $45,000 in savings and tax can lead you to be paying tax on over $1 million. Well, how does that work? So this slide has got a lot of numbers on it. I don't want you to worry. We're just going to focus on a few things. First is, 35. We'll call him Bob. He puts away $5,000 a year at 35 and does it all the way to 65. We'll just say he's doing an IRA and he's going to earn on average a 7% return. So if you look at the chart, we've got $5,000 over 30 years, making 7%. What does that do? Gives us $528,000 in an account balance. So at 65, he retires, but maybe he has a pension, doesn't need the money, and he doesn't draw on it. But he gets a little more conservative because he's taken some advice, and he makes 5% up to year 73. And at 73, he's got to take required minimum distributions. The required minimum distributions start at about 4.5%, so it equals about $26,000, $28,000. But he's still making that 5%. He's still invested conservatively, but making 5%. Well, from 73 to 85, he has now taken out $486,000 out of his account, which means he's got to pay taxes on $486,000. Well, if he's in the 30% bracket, if you add federal and state, which is realistic, 30%, right? So you're at, 3 times 4, right? That's a good number. And oh, by the way, we also have another 758,000 left in the account that still needs to come out over the years. Maybe he doesn't get to use it. Maybe he passes away. Well, that 758,000 doesn't become tax-free to the beneficiaries or his wife. It still is going to get taxed. So now he's got a total taxable account of over $1 million that he's paying at least 30% on in most cases if you were a good saver. And so you saved paying tax on 155,000, but now you're paying tax on over $1 million. It's not a great deal. And so that's one of the reasons why Roths came around and why people are talking about, well, what can we do, right? Well, one of the things is if you're young, you invest in Roths. If you're 60, should you be investing in Roth? Depends, right? Depends on the situation. But if you're in your 40s, probably 50s, toss up, kind of depends on your overall situation. So what do you do? Well, sometimes we look at, alternatives. Alternatives are specific investments that can offer individuals tax-advantaged investments that provide offsets to taxes that they would have had to pay on certain investments. An example would be real estate, right? So in real estate, some people love real estate. They are serial real estate professionals. They buy, depreciate, and when you depreciate a property, you get a write-off, and that helps offset maybe the income that you're earning. So alternatives, there can be oil, gas, solar, gravel, properties, convenience stores. I mean, the options are pretty plentiful, but all of these alternatives offer some sort of tax advantage depending on your situation. And finding the right one is key to help offset any or some of your tax issues. The other option is, well, we look at insurance. A lot of people will just dismiss insurance as I don't need it. I'm self-insured. Well, that's not the reason you get insurance 5 out of 10 times. 5 out of 10 times you get it for death and protection. The other five, it's an investment vehicle. And it acts a lot like an IRA. You put the money in, it grows tax deferred. And then if you access the money later in life, you can access it tax free. So you can use insurance to help avoid some of the taxes as you are in getting to retirement and things of that nature. The other option is Roth conversions. Most people have heard about Roth conversions, but when you do the math, Roth conversions rarely will truly be more advantageous for people unless they're doing them in a very specific and tactical way. Or maybe you're in your 20s and 30s or early 40s, and then a Roth conversion could work. Depends on your tax brackets. You got to crunch some numbers. But for people that are approaching retirement, yeah, it's hard to make that case unless it's done in a very specific manner. So having these conversations about taxes, about the risk that you are seeing inside the market, your portfolio, in your overall financial world, right? And it's just not, finance, right? There's family risk in there. There's professional risk in there. There's people that thought they were going to work till they're 70 because they love to work and they're being forced to retire at 60, and people all around that, right? It happens all the time. So having a plan put in place where you're proactively looking at all of your assets, you have your assets organized in a file, in a plan, you understand where you're going to be accessing money over your lifetime, and the risks associated with your plan, that is going to set you up for success. And so, we really want, at the credit union, United States Senate Federal Credit, to really just help ensure that you have enough income. We want to help you protect yourself from unnecessary risk. And you can do that in your 40s and your 50s and your 60s. And we also want to help reduce the effect of taxes. That's the name of the game. Every dollar we can save on taxes is a 30 to 40% return on your investment because you're not paying that taxes. So, today, we wanted to just kind of expose you to how important having a plan is, understanding your risks, looking at the timing of when you're going to retire and how much of an impact that is, and then taxes and how important it can be to be tax efficient with your distributions or conversions and things of that nature. So we don't have all the answers today. Would love to answer some questions in the Q&A and kind of live. And then some of the questions are not going to be appropriate for kind of this public forum. We can always answer them at an individual level. My contact information is going to be shared through the chat and then also through the United States Senate Federal Credit Union's website. So with that, I appreciate everybody's attention today and hope you enjoyed the content.
Awesome work. Thank you so much, Michael. We have a lot of questions in the chat, so we're going to go ahead and move forward with some of those amazing questions that we have here. I have Andrea and Eli. Either of you, if you want to take us. All right. Well, I'll go ahead with that. So I have here a question. I'm 55 years old and returning to the workforce after several years of serious medical issues and layoffs. I used to live in the DMV, but had to move to Michigan to live with friends because I couldn't afford the rent. I'm now making 110K annually and no retirement and truly concerned. Yes, I need financial plan, but mostly I feel overwhelmed. Unsure how much I should set aside for retirement, max out 401k while still paying bills. Help us, please, Michael, help.
uh, I, I smile at the help, but it's a serious situation. And yeah, medical situations can derail, even the best intentions and plans. Um, you know, the best part is kind of you moved out of this area, which is an expensive area, and now after coming back from the medical, you've got a good income. What I would suggest is nobody's going to give you a retirement loan. It doesn't happen. So you need to save as much as you possibly can to help augment maybe what your Social Security will provide you at 67 or 70. And in this specific, we would have to have more of a conversation, but off the cuff, I would say, well, work till 70, save as much as you can, and just pay your bills and in good order, but don't try to accelerate paying them. You need the market returns. And so the best way to do that is have your money, working for you in a way. There's going to be trade-offs. You got to take more risk because you don't have the money, right? So there's always risks that you have to choose to accept or not accept, and that will help determine how you go about moving forward.
Okay, awesome. I hope that was answered your question there. We have another one. Please talk about TSP 4% withdrawals versus a TSP annuity.
Yeah, the TSP annuity. So if you take your TSP and annuitize it through the federal government, it's I believe it's still Bright House or MetLife. It used to be MetLife, which is now Bright House. That is annuitization, which means if you do that, you lose access to your principal. So if you had $500,000 and annuitize your TSP, sorry, I'm losing my voice. And you died tomorrow after annuitizing, your heirs get zero. So I would normally advise against annuitizing your TSP. Doesn't mean you can't put it into an annuity. Again, an annuity might be a solution for part of the funds to supplement an income stream. An annuity basically is a private pension. Instead of your employer guaranteeing the income payments, it's an insurance company. So depending on what that looks like and how that overall plan looks, would be the decision makers to help decide how do we need this. It also depends on how much risk somebody's willing to take. Some people are fully okay with big ups and downs. Others are nervous Nellies, and I say that with the most care around it, but it's just built into them, right? And they don't want to see the ups and the downs, so they want safety, security, and understand I always have a paycheck coming in. So it varies depending on what's right for them, depending on some other circumstances.
Okay, awesome. I see I have Andrea or Eli back on, so if you guys want to check the Q&A for any questions, that would be great.
I think because they lost connection, they lose access to seeing the questions, but you're doing so good.
Oh, okay, awesome. All right, well, the next one is why is a Roth conversion tough to consider good if you're closer to retirement?
Yeah, so it just needs to be done in the right manner, and most Roth conversions are done straightforward, right? You take $100,000 today, we'll just use round numbers, and you convert it. Well, that 100,000 counts as income for you today, this year, right? And it's probably going to jump you up in a tax bracket. You're going to pay a larger amount, and you want to have cash to pay that tax. You don't want to pay it out of the Roth. Or what's going to be the Roth. So you want the 100 to turn into 100 in the Roth and maximize your income. Most people, it's harder because they don't have the cash to pay it. That's one issue. And the other thing, if you're older, you need compound interest, right? Time value of money. And so when you do the calculations, unless you are going to say you're in the 32% bracket federally plus another 6 in the state, and you're going to drop down into the 12% bracket, then maybe it can work. But most people who've got the ability to do Roth conversions or have the desire are not in those different tax brackets. You'll be largely in the same tax bracket your whole entire life in retirement, if not going up because of RMDs. So you need a lot of time to make up for that 30% tax that you're paying. Even if you don't take it out of that actual IRA, what could that money that you took to pay the tax grow in the interim? And so when you compare it, you got to live well into your 90s to maybe break even. If you're in your late 50s, 60s, it depends on your tax bracket. So I'm not saying we do Roth conversions, but we just do them in a very tactical way for the right reasons.
So, Michael, what are the drawbacks of annuities in retirement?
So annuities in retirement, there's pros and cons. Pro is it gives you guaranteed source of income, or it can, depending on the annuity. There's lots of different types of annuities out there. There's income annuities. There's annuities that guarantee against loss, but don't give you income. There's, I won't get into them, but overall, annuities transfer your risk, right? So your longevity risk, maybe you live till you're 103, right? You've got good genes, something like that, but you only have a certain amount of assets. Well, I'm going to put them in an annuity and guarantee that I'm going to have at least 35% of my income for life. The rest of the money I'm going to have in the market. That might be a good thing for you. The bad thing might be, well, I'm going to put 35% of my retirement assets in there, and now something radically changed in my life and I need those money. It's not liquid, right? You've made a contract commitment, so there's a lot of different types of annuities. Annuities used to have, well, and they probably still do have a very, people don't think very highly of them. But what I will say is annuities for the right reasons and the right situation as a part of a portfolio can make a lot of sense and take a lot of risk off the table. So you can then take on more risk in the different parts of your portfolio.
As you can see, there's a lot of options. It depends on the goal and your income and all these factors that Michael is talking about. And I think it's just a matter of asking the correct questions. Like if you have a vision, Michael can put you in the right path. He has, so many successful stories with our members and testimonies, and that's the reason why he's very popular. Like this guy is on demand, honestly, and I'm not just selling it. I'm saying it's actual facts. And as you can see, he's very knowledgeable of his, on this field. And that's the reason why we encourage you to contact them directly. I know that Kerry shared his email and his link for his schedule earlier. I know a couple of people are having some issues with energy going on and off and perhaps missing some comments. I know one of the attendees mentioned that. So that's the reason we're resharing that again. But I think the point to emphasize is just to ask the questions, like what's your vision? And best believe that we will have the answer for you. Another question, if you have a small pension that pays 300 monthly, should you ever turn it into an annuity? And I know you mentioned something about that.
Yeah, if you have a pension, it already is basically an annuity, right? An annuity is just a guaranteed payment in most cases on a yearly or monthly basis. It's a yearly number, but paid monthly. That's what a pension is, but it's guaranteed by your employer, the union, whatever. If the question meant to be, hey, I've got a small pension, should I take a lump sum and then put it into an annuity? That's a different question. You would have to run the numbers. Sometimes it makes sense to take a lump sum payout from your pension because where you are in your life and your age and their crediting mechanism isn't going to be very high. And you can improve on that by utilizing an external annuity or external investments. It doesn't have to be an annuity. So it really kind of depends on the situation. If that was meant to be the question, in regards to if you have a small pension, you're not going to change it into an annuity. There's no reason to. It's already doing that exact same thing.
Love that answer and great explanation, and it puts it into perspective as well. Jarnika, what do you see on your end?
Yep. So I have here when you start to receive your federal pension, not TSP, is that pre or post-tax income?
It's pre-tax. You're going to be taxed on that money.
Okay, awesome. And then the last question I have here is there a way to transfer TSP or I think that says FERs,
First,
pensions, to a 529 or other education fund for kids without paying taxes and transfers the money?
no, you cannot take your FERS as a pension, and that will be paid out monthly to you as a benefit, and that counts just the same as income. Your TSP, depending on how you contributed to it, will be pre-tax or after-tax money, but that will ultimately be rolled into an IRA at some point and cannot be moved into a 529 without tax implications. There are other things that you can do to minimize the tax and then put the money afterwards into a 529, but that's a longer conversation.
Okay. And then I'm 59. Over the years, I've used my retirement to purchase a home, support family, and so I have not prepared for retirement. What do you advise?
I would say, in a way, you've just moved your money from pre-tax to a taxable asset, right? Being in your house, right? So your house hopefully has significant equity since you bought it. Um, the answer might be, hey, I'm able to pay down my mortgage enough where I can still live here and kind of have a simple life or a life that I want to live. Or it might be, once I'm done working, I have to sell and I have to find a lower place of rent, like somebody who had previously said they moved to Michigan, right? Just depends. If you're in a single family home, maybe you move to a condo. I don't know. But the other thing is, can you find a part-time job that you like, that helps offset some of your expenses so you can stay in your home? You're not being at 59, it's going to be harder to accumulate a significant sum of money because compound interest takes time. So your lifestyle is going to dictate probably how you live and how you can make money from 59 up till you turn on Social Security.
Awesome. Thank you for that, Michael. And last question is, what do you think about paying a firm 1% to invest for you?
Yeah, so I think we charge clients fees, right, to help manage and plan, and it's all about the value that you're receiving. Money, how much money that you have accumulated and are managing, and how much help you need, and the frequency is all going to play into the fee structure with the advisor that you talk through. 1% is probably the industry average, give or take. And when we're working with clients and we're able to save them, $30,000-$40,000 on taxes, and 1% sounds pretty good. So it goes down to the value that you're receiving from the person, or the firm that you're working with. So I wouldn't get caught up on, should you ever be paying 2% to an advisor for managing funds? No. But, you go to a doctor for their expertise. You go to an advisor, financial advisor, for their expertise. You go to somebody who's in marketing because, to build your business because they have the expertise, right? So it all comes down to the value that you're
Okay.
Did get
Awesome.
some questions. So the next question is, can you talk about currently using TSP with financial advisor? I'd like to retire from my current job and explore passion projects.
Yeah, I would just say to that individual, engage in, but it's going to be about building a plan, looking at what you want to do. Do you have, these passion projects, are they going to produce income? Are they not? Could they eventually, but not in the beginning? You got a scenario plan, look at your assets, look at kind of your standard of living, all of those things will play into the fact of, can you retire from maybe your day to day and pursue those passion projects? But an advisor should be able to help. I know we definitely could, help understand the risks and the situation, whether or not they can do that.
Awesome. I don't know if the service is going out for everyone, but I have one more question here. Can you talk about changes to expect related to Social Security and Medicare slash Medicaid as a result of the BBB bill, and how it may impact retirement planning?
Um, so we're still digesting it. That's my cop-out answer. But Social Security, yes, there's a provision that will make a little more of it not taxable for certain individuals. It is not a it was not a bill that eliminated paying taxes on Social Security 100% for everybody. That's a misnomer, but it did help, and it will reduce the taxes on some Social Security out there. On Medicaid, um, there is a work provision that is going to be enforced more. So if you're on Medicaid, not Medicare, Medicaid, you have to actively show that you're working, if you're able employed and not a caretaker. So that's a change. It's a little more strict on that side. On the retirement side, the biggest thing was the tax brackets. Federal income tax brackets have been locked in for another 3 years. The other thing is the estate tax provision dollar amount, the exemption. That was due to, at the end of this year, sunset and go back to previous years. That's going to stay elevated at least for the next three. So right now it's going to go to, I want to say it's going to roughly 17, maybe 20. I think it's 20 million per person. So if you have significant assets, you built a business, inheritance, whatever, and you have more than that, the federal government charges 50%, takes 50% of it in the estate tax above that exemption number. So for the wealthy, it was, it's a little bit of a help, at least for the time being. But those are farther and fewer apart.
Okay, awesome. Oh, last one is, what are some smart, less tax consequence ways to, I think this maybe withdraw from out of a 401k?
Yeah. So if you are taking money out of your 401k for R&Ds and you don't need the money, you can have that money go directly to a charity and it'll never hit your income, which won't create your income number going up and potential for more taxes. So it'll be agnostic to your tax implications. If you do need to take the district, there's really no way around, paying the taxes. It's just how much are you taking and what is your total income, and looking at what other investments you have that could possibly reduce your taxable income. So there's ways, but you got to normally have other assets to help out.
As you can see, Michael has the knowledge, he has the experience. We appreciate you for asking these questions. Some of them were very complex and some of them were very simple. We appreciate you for, sharing some information with us this evening. And I will pass it on to Milton Aguilar Bolanos, our Membership Development Officer, with our closing remarks.
Awesome. Well, thank you so much, Eddie, and thank you again, Michael. As always, we love and enjoy having you every time you get a chance to come and talk to us about everything that's going on, and we are so appreciative of that. And also thanks to everyone that attended. I know this was a very, very important topic. There were a lot of questions. If you have any more personal questions that you would like to ask Michael, please reach out to him. We did record this presentation, so it's going to be we're going to go ahead and post it into our website under the Best Life tab. I'm sorry, but also we are sharing Michael's information as well too. So if you need to reach out to him, give him a call, send him an email, or even better, schedule an appointment directly through our website. Michael would love to talk to you. Michael, you want to tell him how much does it cost to set a meeting with you? What's the fee for that?
$1 million. No. No, so because we're partnered with the credit union, so we will have, initial conversation. or to, 100% complimentary. We're going to make sure that we can offer value, right? We talked about value, so we want to make sure we're helping people. Sometimes a lot of conversations are one-off conversations, and you go on your way. Other people have more complex conversations and want to do more personal planning or long-term planning, and so then they become a client. And so, but there's no pressure. We're not here to sell widgets. It's really to make sure that we're helping people accomplish their goals.
Awesome, thank you, Michael. And we really love that, and that's one of the reasons why we have partnered with Fellows Financial, and most importantly with Michael, who has been doing this for many years, and he is, like Eddie mentioned, the members that use Michael for their as the financial advisor really give testament of everything, the impact that Michael has made on their retirement planning. So thank you so much for that, Michael. And again, also want to my wonderful panel, as always. We do apologize. We did had a little bit of technical difficulties. There was some severe thunder weather here in the DC area, so we do apologize. But again, we will have this recording available to you very soon. Also, a copy of the presentation will be emailed to everyone as well in the next couple of days. But before we let you go, we just definitely would like to invite you to our next webinar next Wednesday, which is Spot the Spoof, Protecting Yourself from Phone Scams. This one, it's on the rise. Matter of fact, I can share a really quick story. My neighbor who owns a landscaping business, he just fell and became a victim of a scam just yesterday. Believe it or not, this is something that is happening. So if you wanna come in and then get some tips and tools and resources that are available to you, should you become a victim of a phone scam, or how to protect yourself, which is the most important thing. Please come back and see us next week, next Wednesday at 6 p.m. For another weekly Wednesday webinar. So with that being said, thank you all, thanks to everyone. And we look forward to seeing you back again next week. Have a wonderful evening.